I had my mic muted. All right, what's up, guys? Sorry for that. Welcome. Happy Thanksgiving in case you were celebrating it. Back here in Europe, it's not that big of a thing. So, personally, I will just be working, but I realize a lot of people up in North America will be celebrating this. So, I hope you have a good day. I expect a little bit more quiet day on the markets because of it, but we're just going to dive into that. I want to use today as well to kind of explain the 80% interval ranges. I know there's some questions on it. Uh, Even though it's still in highly beta phase, I would even say it's in development phase. I'm almost ashamed I pushed it live like this, but it's funny to see that it's actually getting picked up more than I thought it would. So that's a good sign. And I want to dive a little bit into that, what it is, how to use it, how to interpret it. And we are also going to look a little bit on I'll probably start off with my thoughts on the market in general and on Bitcoin, what I think is going to happen most likely. So far, we have called this price action nicely. We said here that we were looking for a top, and the top indeed came, and this was because of some timing analysis. I actually really want to gather, I've shared it in the Discord. I really want to share statistics on it. I will do it at some point in the future, but it's going to be difficult because you need to create a very difficult rule-based system on tops and bottoms. Hello, Elena. Happy Thanksgiving to you. In case you're celebrating, good to see you. But so for now, we saw the top coming, and then price went down and then reached this zone right here, the 1991K, which we were looking for, one that I personally longed. I think I'm long from like here or something, almost the bottom, 2109 or something. This is a swing long position, but I think it might be open for a while, and I'm going to dive into why I think that in this stream. So we saw that drop coming. We saw this as, or at least this was what I was looking for as the bottom. I will make a post later today on Twitter and probably share it in Discord on why I thought that was going to be the bottom. So far, it's playing out. The one thing I was looking for personally, as I've shared, is this right here to kind of, sweep this one more time and then go up. But I've now extensively shared that I think the probabilities for that happening is a little bit less because of this, because of this green bullish fair value gap right below us. I'll just show you the post I made, and then we can tick that box off right here. So we have these two fair value gaps, and we have the following statistics for them, right? So this is just, we're looking at, okay, how fast do they usually reject? And it's actually funny because I also posted yesterday that, the last line in the sand I was looking for reversal was, there you go, that right there, right? So yesterday I posted, okay, this is the last, if we want to make a new weekly low, this is the last thing I am looking at. And if not there, then, it's not going to happen. So this was the point of interest I'm looking at. So far, price is rejecting from that point of interest, right? We're rejecting from that fair value gap, which makes sense because the thing we were looking at yesterday is that we said, okay, if it gets, basically what I said today, if it gets tapped at the end of yesterday, right? So yesterday was at the end of today, but at the end of yesterday, this is the right column, what we're looking at. So what are the chances of it getting tapped, getting filled, and reversing? So we see that, by the end of yesterday, the 72.6% of similar fair value gaps would have had at least the first tap. Now we got that first tap. But we also saw that 32% would have seen a reversal. So the conclusion was, it is a lower probability that this one is going to be taken out. And when I say reversal, what I mean is, in this case, we have a 4-hour fair value gap. What I mean is that we need a close above the candle that printed the fair value gap. So in this case, a close above this level right here. And that makes sense, if we're looking for, okay, are we going to take out the weekly high? Then obviously we need to reverse, well, we probably need to reverse this candle. So 32.9%, 1 out of 3 days would do that. So we said, okay, that's a little bit less likely. But on the way up there, we printed this other fair value gap. and then we go back to this one. But we printed this other fair value gap right here. And this is something, and as I was saying in real time, okay, that's something you preferably would not have seen, because the fresher the fair value gap, the less likely it is to reverse. And this is something we see right here, because so this is saying, okay, by the end, we're asking the same question, but in this case, I'm asking, okay, what are the odds of reversing this thing by the end of today? So this day. So I'm doing that for both, and we can see it's 42.3% for the bearish fair value gap and 19% for the bullish fair value gap. So you're pretty much in between a rock and a hard place, where both options are, well, this is almost a coin flip, a little bit less, less than a coin flip, and this is 1 out of 5 days. So the more tempting solution would be to say, okay, well, the bearish fair value gap, therefore, is the better odds of breaking it. But I would argue that, and I would say, no, that's not the right conclusion, because both of these do not give an edge, right? Both of these are saying that it's less likely to break it. So what I actually think is a probable scenario, especially since it's Thanksgiving, is that you're just gonna, at least today, range in between just here in this fair value gap, would be a logical conclusion. Then I want to take one step back, because the reason I was looking for one more time this, one of the reasons is that you see it, we have a P1 on Monday and we have a P2 on Tuesday. Now, P1 Mondays, P1 Tuesdays, if you have been following for any amount of time, you probably already know what that means. Simply in terms of time, we have to, look at this, absolutely insane. In the last 30 weeks, because here I have 30 selected, so I'm looking at the 30-week moving average. In the last 30 weeks, 86.2% of weeks put in a P1 on Monday. So that's why I always say, if you have a P1 on Monday and you take out the Monday, in this case, the weekly highest month is on Monday, and then the weekly low was on Monday, but got taken out on Tuesday, that immediately by itself makes this a high probability pivot to hold. So, you're kind of putting together all the pieces of the puzzle, and you have like, okay, this is at least for today a lower probability to break. Probably the rest of this week, more or less a coin flip. But this one, if this breaks, naturally, because you have to break this level, remember, that's a reversal. So then naturally you're taking out the weekly high, but we know the weekly high is a very high probability pivot. And when I say high probability pivot, I mean it's very likely to hold. So, you put these things together and you're like, okay, likely it's not gonna go there to the high, right? It's not something I would bet on. Yes, I'm in a long from here. Actually, I haven't traded in a while, but in this case, it just seems too good not to do it. I don't think we're going to go much lower than this, so I just hold it as a swing. It's basically a spot position. It's low leverage, but as a building a swing long. But what I think right now is that you're in between this resistance zone and this support zone. So the most likely scenario, or at least for me, this right now is a no trade zone. Right? There's no trade to be had here, because this is moderately unlikely to flip, and this is unlikely to flip. So for me, I'm just not going to do anything. I wouldn't short in this market anyway. But I know, for example, that Azashin is short, and I do think there's a very, very valid case to be made for a short, because in the end, just like with technical analysis, it's also just a cake of confluences that you're looking for, And if you're looking for confluences for a short, you have the weekly P1 on Monday. You can discard the fair value gaps if you would want. Because in the end, it's not about using all the statistics. It's just about using the statistics that you would like to use, right? Just like with TA, you're not using all available tools. But we have the weekly P1 on Monday, the weekly P2 on Tuesday. And moreover, if we look at the distance statistics, let's grab that one, is that we have that weekly distance between P1 and P2, 72.4% of weeks see more distance. So I know that's a reason why some people shorted. And all I can say is that that's a perfectly valid reason. if this is your system, then it makes sense to take it. Personally, I wouldn't do it because I'm just in this environment. I think looking for longs is over the long run the higher probability play. But if you stick to your system and this is a system trigger, then it makes a lot of sense. P1 looks safe. This is extra resistance right there, as you can see now as well. We see that 72.4% of weeks would go down lower than P2, and therefore you could just say, well, this is a nice trade. I will take it regardless. I mean, you have a great, really great RR. I think just doing it like this. I mean, 2.7 just to the weekly P2. And statistically, it's back, right? So, yes, it's a valid trade, right? Over the long run, this would work, especially if you look at, because if you put everything together, the weekly high seems safe, right? I personally do not expect this to blast through 100K. What I think is more likely is that alts are going to run, which is also why I want to look at alts, and that Bitcoin just kind of like does nothing below 100K. But for example, here Tuesday, it's been 27 weeks since Tuesday put in P2. It happens only 6.1% of weeks as well. So given that the weekly high holds, then this is a very low probability weekly low. Very low probability. So, if you put a gun to, like, preferably I would say, well, I think, especially since it's Thanksgiving weekend, there is a good probability that you're just going to like die in between there. And then, yes, you're going to have like a very tight consolidation range where nothing happens. But if I would have to choose, I would go for the weekly low because statistically it's backed by more. It's backed by more data than taking out the weekly high. Plus, I just think that in the end, everyone always becomes too how do you call it? Too eager for 100K. So here, remember, everyone was like, "Oh shit, we're dying. It's going to 88K. It's going to 85K. It's going to 80K. I've seen 70K even." So everyone's panicking. Then price goes up, and everyone is like, "Oh, we're going to 100K." I'm like, "Well, chill, guys. That's probably not going to happen. What's probably going to happen is something in between. So either this, which I think statistically is still the more likely scenario, or right now what you can see is just something like, I don't know. Oh, not that one. Something like this. But if you would put a gun to my face and made me forced to choose, I would say the most likely scenario would be this because of the statistics. All right, so that's Bitcoin. But at the same time, we have good news because Bitcoin dominance is finally breaking down, which means our season to start, well, at least it looks like it's breaking out. I think it's too early to confirm it, but you do have some early structure breaks here. I personally think it's too early, but the first signs are good. If you're wondering what this green box is, this is what I have marked out for the potential first start of alt season. And then this is kind of the alt season zone. This is what I've been looking at. So pretty close to it. Like how far away are we? Like a month. It could take another month, where you just have like a mini alt season here, drop, and then something like that. But we're definitely getting closer. So we can look at alts more, and that's also what I think. It's also what I said in the post I made earlier today, is that I think alts or Bitcoin also going to perform better. Bitcoin is going to grind a little bit, consolidate a little bit below 100K. And if you think about what Bitcoin likes to do, it also makes a lot of sense. Stop short of 99.7K and then just do nothing and wait a while before breaking that 100K. So personally, I've mentioned it here. If we get the retracement, I wouldn't expect Bitcoin to see past 100K for at least 2 weeks or so, which I think is happening now. But again, we have this Thanksgiving weekend, and I've heard also a couple of times now that most in the past, apparently all price action takes place before the Thanksgiving weekend. So, it could be that it's just going to be a slow bleed like this. With all that said, I want to dive into the 80% interval ranges. I realize people will be asking questions about it. So first off, I just want to explain what it is, right? And then I'm just going to probably focus on how I used it yesterday to find a pretty epic trade, if I say it myself. The first time I tried to use it like that. I will also explain my further plans, but for now it's important to understand, okay, what exactly is it? How do we interpret it? And I think that's it. We'll go from there. So first things first, the 80% intervals. I'll start off with explaining it in the daily, or sorry, the weekly time frame. So let me get rid of these right there. 80% interval ranges. So what we can do in the dashboard is we go to this, development version. I don't even want to call it a beta version because this is, well, this is not something how I deliver the products usually. So this is really a development version that I just threw up online. Something I already noticed is that I need to filter out the assets who do not have enough weekly data. That's why, for example, you see here that Peppa has 20 cents everywhere. That's because there's no data to work with. But let me check Bitcoin. All right, so Bitcoin right here, we have, wait a minute, well, we can already see it here. So we have the open price for this week. So I have the weekly time frame selected. And what it's basically going to give me, it's going to give me the intervals in between which the P1s will most likely occur 80% of the time, and in between which P2s 80% of the time the P2s will occur. So I've drawn it out here on the map. Let me just screenshot that so you get a better picture. There we go. There we go. So you can see here P2 interval high, 110, 430. P2 interval low right here, 88, 461. I need to rename this to P1 interval low, and so on. So what is happening on the background is that Bitcoin, the Minoma Analytics platform is looking for this period, what I selected, the last two periods. It is looking in which price range 80% of the P1s and P2s have occurred. And 80% because I have marked out 80% in the confidence interval box. You could choose 70%. I think 80% makes sense, so I'm just going for 80%, but feel free to change it. So basically what you see here, it's calculating in which percentage range from the weekly open P1s have been put in, right? So we have the weekly open right here. And basically what it calculates is that, okay, in the last 2 years, in which percentage range did we see that, let me draw that out, this is the weekly open right there. Which percentage range do we see P1s being put in? 80% of the time, right? So what is that? What you have to think about it. Let me just open another one right there, just so that it's clear. Distance, weekly. So basically what you're doing is you're drawing out the zone where it's 80% of these occurrences fall under. So for example, if I put this to manual, as you know, it's 7%, which is never going to happen, 6%, 5.5%, more or less. So you see that after 5.5% above, that's where, the outer 20% of P1s lie, which means that 80% of the P1s lie below 5.5% from the weekly open. So you could probably check that, and I'm guessing that it is, all right, it's not the same date range, but you get the idea. In this case, it's 4.3%. I'm using more data here. I think it's actually nicer to not use too much data on the weekly as well. So yeah, here you see it, because recently it has been a lot less. So recently it has been more or less, let's see, 4.5%, which is why you see, okay, it just calculated for you on the background where do 80% of P1s occur. So in this case, it's in this zone right here. It does the same for the bottom. And then therefore it calculates, okay, what you see here basically is 80% of weekly P1s happen within this price range, right? Because it calculates, okay, it's 4.5%, and then it just takes the current open price, adds 4.5%, does the same for the bottom, calculates them separately, and there you have it, right? So what we can now say, as soon as the weekly open is, okay, with 80% certainty, the weekly P1 will be put in here. And with 80% certainty, it does the same for P2, right? Which is, in this case, the weekly low, but could be the weekly high. And in this, it checks, okay, in 80% certainty in this box, we will see the weekly P2. Obviously, if the weekly P1 is the weekly high, you're looking for the 80% of P2s, you're looking in this box right here. This is where you're looking at. If the weekly P1 is the weekly low, then you're looking at this box right there for the weekly high to be put in somewhere. And with 80% certainty, it is going to be put in more or less there, right? Obviously, it's an estimation because if suddenly the percentage changes would change drastically, then obviously we are screwed. But as long as it holds, that's also why I'm gonna. Well, we're not screwed, but it just doesn't change that fast and that drastically. But I will also be implementing short-term change trackers that we can kind of get an idea of it. But so far, I've been testing it out. It works pretty well. It makes sense that it works pretty well because it's just based on statistics. So that's the essence of it. Basically, it gives a more holistic view than what we've already been doing, right? So I'm gonna first look at what we have been doing here with the old statistics, and then I'm gonna explain how the new statistics is a new approach to it. So say, for example, we look at the old approach, or not the old approach, just the alternative approach. For example, here we say, okay, the current distance from the weekly open to the current weekly low is negative 7.4%. Right? This negative 7.4% go down. Here is negative 7.4%. And we see that only 6.7% of weeks would go out to take out that low and then keep this low right here, right? Then keep this low right here as the low of the week. So also based on that, it's, another confluence that it's very unlikely that you're going to take out the weekly high, right? I don't see it happening personally. So that's how we used to do it. Basically, what you're doing here is kind of alternative approach to it. So we know that basically when price is here, or just slightly here, then this metric will be 20%. We can test, we can kind of test that. Like how far from the weekly open is that level right there? 3.5. Is that correct? I think so. And you see it's quite different from the positive displacement. That's because it's calculated separately. It gives a more accurate view of where weekly highs and weekly lows are in fact being put in based on which one gets put in first. So you see that indeed at that point, when we're more or less there, it's actually negative 3.58%. At that point, it's more or less, it's not the exact same date range, but it's more or less 20% chance of a P1, P2 flip happening, right? So in that sense, we're looking at the same thing. So you can just say that, the highest probability is to put in P1 within this box, and the further price goes away from that box, into the P2 zone box, the less likely it is to flip it and hold it, right? But there's a catch. We have more information that we can work with. For example, all that we used to do is, check this, and it's still completely valid to track it. And, I will continue to use that function. But what we can now also do is, for example, say this would happen in the week, and you say, well, there's 20% chance we break it. You could do this. So take that high, right? Take out that high, and you say, oh, we flipped the P1. And then you could go back down again. what happened is effectively this P1 is still in a high probability zone. And in this case, it wouldn't be high probability anymore because you have the weekly P2 on or P2 on Tuesday and P1 on Tuesday, P2 on later. But just for the sake of argument, you still have it in a high probability zone, and then you can come down later. So you know this is a high probability. Now, I don't want you to think of this as a deterministic zone. What I mean with that is it's not that if price wicks through this like this, that doesn't mean that immediately this means it's invalidated to become a P1, right? So say this is the price action, and then here we would say, okay, here this means P1 will not get taken. That's not how it works. Again, it's a probabilistic zone. We know that 80% of P1s are put in within this zone. And the further away we get, the less likely P2 is to be P1. And, that's the same theory as here, right? The further away we get, the lower this value, the less likely it is to take out P1. However, we can now also see, I'm going to show an example on ETH that's going to make it more clear, but we still have a more holistic view. Okay, where is P1 going to be put in? That means, especially on the daily, we can flip it later on in the day. So in the daily, sometimes you see this, hour 0, P1, then this, and then continuation, right? In this case, we still have that information that if we sweep that it might still make for a good short, which otherwise we would not have had. But I want to show you Ethereum, which kind of brings the point home. There it is. All right, and I'm just going to do this. I'm just going to play Captain Hindsight for a bit because that's what I do. Just for the sake of explaining, because I just want you to understand that this is known from the moment the weekly opens, right? So for the moment the weekly opens, we know this zone. We do need the weekly to open because we need to calculate it based on the opening price, right? So we need to know, okay, where does the week open? And therefore we cannot forecast it for next week or something because, unless we would be able to predict where the open will be, but that's going to be difficult. But in case you look at it in the weekly open, and here you see immediately, okay, now I have my zone in which weekly P1s will get put in, and my zone in which weekly P2s can get built in. Put in. What you can then do is basically just align your TA and look for high probability pivots, right? So your first question would be, okay, where are we going to put in the first weekly pivot? Because you know that in this zone with 80% certainty, you're going to be putting in the first weekly pivot, right? The high or the low. So this can help you determine saying, okay, which one is more likely. In this case, I know, for example, Yip had a really good, his bias was long because right now Ethereum Bitcoin is showing strength, right? It really depends on your analysis. Ethereum Bitcoin is showing strength. Bitcoin dominance is dropping. Everything has the eyes of that it's ETH season. And what happened here is that you had this little manipulation. I don't want to go into the technical analysis too much, but say your bias is, okay, it looks more primed to go up than go down. But what you can, you can even hedge it, right? So basically the two areas I would personally be looking at is this right here. This is obviously a liquidity zone, basically a resistance here. Liquidity zone, but also this one right here. So now from the start of the week, we can already come up with a plan. We're like, okay, well, this is at the moment resistance, right? And it's a really good place to put in a potential P1. So this is something, either you're all in TA. I don't want to go into it too much because I won't have time to do it thoroughly. But you have some, other point of interest that you're looking at. You can say, well, this is an important point of resistance, and this is a very important line of support. Because both of these are important resistance and support zones, or at least liquidity points, and they're both within the 80% P1 interval range. Now, in this case, I think it's a pretty safe bet that the bias for ETH was higher because of things I mentioned: strong uptrend here, consolidation, and now you're pumping up. ETH Bitcoin pumping, Bitcoin dominance dropping. So you have the perfect setup there. So what you can do is basically just have your alerts set at your zones, and then you just wait for price. So first price gets to this zones. I mean, depending on your confirmations, you could take a short here because I already know what happened. I'm not going to pretend I don't know what happened. So it's funny to see that you do reject from the top of that zone, right? This is more or less 80%. So at this point, you could say, okay, well, this is a valid short. This could turn into P2. But then what happens is you take the low right here, and instead of pushing through, price reverses, puts in a nice bottom right there, which you can see with these candles. Like this is a great bottom. If you see this, like wick down, or at least a candle down, candle lower, candle close, candle low higher, and up. Great bottom, right? So if you see this and your main bias is up, then what you can do is say, okay, you long this, you target high, and you know that if this is going to be the weekly low, then with 80% certainty, it must hold somewhere in this zone, right? With 80% certainty, and you can just fire it up from there. And as soon as you take out the weekly high, that's when you know that weekly P1 is safe, right? Because now you're entering, or at least very likely safe, because you're entering this high prop of the P2 zone right now. And all that's left to do now is say, okay, where is this thing going to end up? And that's where we can use the P2 interval. This is the high, not the low. Interval high for, right? So we know that 80%. So now you can be pretty certain that weekly P1 will hold, right? Because what we have now is that 80% of weekly P1s happen in this box, and we have the weekly low there, and you see the weekly high is very far. And again, you can check the statistics on this. So we can just go to Ethereum, and then, because this is basically what you're doing, right? This is what I said. The further away it gets, the less likely it is to become P1. And here we can see, to be exact, in terms of weeks, that is a 6.5% probability, right? So there's a 6.5% probability the price is going to return and do this, which is not going to happen. Or, well, never say never, but likely not going to happen because things do look very bullish. If anything, I would say that this is probably a nice area to load up on a further position on Ethereum as that fair value gap right there. We can actually check statistics on that. We might as well. Let us check some statistics on that. Let's just come up with a plan using this. So the question is, are we going to proceed further within this range? We know that 80% of price would end up within this range right here that we have marked out. Now, the exception to those 80% is usually strong trending weeks, days, sessions, and so on, right? Because the 20% that goes the furthest, and it also aligns very well with actually the general statistics of the market. That is 80% of the time it's ranging and 20% of the time price is trending, right? So the 20% of the time here is very dispersed, right? It's not like that you have the remaining 20% here, right? That's not the case. The remaining 20% is like this. It's the same normal distribution. So you have to look at it kind of like, it probably starts here, and then very little, very little, very little, and then most of them are here, goes down normally, and then very little, very little, very little, very dispersed, right? Oh, no, I did such a good job drawing that, and I accidentally deleted it before yeah, well, you get the point. So, if you have a trending week, then you can say, okay, we're going to go much higher, right? But it's up to you to decide whether we have it or not. I have seen in the data that trending weeks, I cannot show you this now, but trending weeks tend to happen more when P1 is close to the weekly open or daily, or at least I know it's true for the daily open. Actually, I haven't checked for the weekly open. I can check it. But you see that you don't want to have, for example, if this would happen on the daily and then you take out P1, then you're probably not going to do this, right? Usually you just see some range bound action or some more conservative, something like this or something. So I'll check on the weekly if that's the case as well. But now we can say, okay, we have the P2 interval. So 80% of the time we will end there. We can also use this one. And, this is funny because right now you see how everything kind of works together. We have now, in terms of weeks, 50% of weeks see more displacement than what we have currently had for Ethereum. And we now are somewhere in the outer edges of the 80% zone, right? And what you have to realize is that you're measuring the, I don't want to make it too complicated, but basically the further down you go to put in a P1, the lesser the chance is to go higher up in this P2 zone, right? So if you have the P1 right here, for example, go up, then you have a much higher chance of reaching the edges of this zone than if you do something like we have done now. However, once again, we're in a bullish environment, so there is a chance for a trend break, but I would really advise to have like proper confirmation for that, proper system that you know you're in a trending environment, which I do think we are getting at for Ethereum. But another solution would be that you see something like this followed by trend up later in the week, right? Also very possible. So the cool thing is now that we can you can use this for your expectation management. We know that 80% of price action will end within this week or within this price range. So therefore, you know, if you're just looking to take a trade for the week and close it, then obviously you will want to close it somewhere here at the end of the week. And the best way to do that is by using support and resistance zones. Now, how we done that yesterday, I want to go over that, how to apply this effectively on the lower time frames. But yesterday we had a really nice example on Bitcoin, and obviously you can do this on all coins. I do want to stress that I am going to make this feature a lot more user-friendly, a lot more better to interpret. I'll probably make an overview just like I have right now for all the other assets where we can see instant statistics. So right now, for example, what I would want to see in Ethereum is, okay, where are we in that, or if I just have an overview where I can kind of see, okay, Ethereum P1 is within the 80% zone, P2 is at the highs of the P2 zone, you know, something like that. Sub Robin, beautifully drawn standard distribution. Thank you. I was also proud of it until I deleted it, but it is what it is. But going on to the daily of yesterday, right? So yesterday we had the situation which was as follows. And this is also, let me check, Minoma analytics indicator. I updated this indicator again yesterday, by the way, just so you know. All right, yesterday, the situation we had was that we had a I was looking at this at 10 a.m. right here. Or was it a little bit later, maybe? Yeah, here it was. Pretty sure this was it. I documented live in the Discord. So this is hindsight, but I wasn't doing it in hindsight yesterday, right? Check the chats. But I just want to lay out my thought process of how to use this. So let me check which one. Okay, this is the daily range for today. Yesterday we had the session range, and this was the session range for yesterday. So we have the situation where daily P1 is our 0, daily P2 is our 10. We've made quite some significant displacement. So in terms of the daily, like 2.38%, I mean, we can do that now manually on Bitcoin. Switch that to automatic, 2.8? Am I saying that right? 2.4, sorry. So, you know, you already have this very low probability of taking out the low, right? 13.6%. Not only that, you also have a P2 with our 10, which is, you know, one of my favorite pivots to trade into because it is just a horrible P2. It's also not a very popular P1. You can see it here. Our 10, 2.9% against 1.1. We actually have it again today. So 1.1% chance of being P2. It's been 98 days. I mean, look at this whole zone, right? It's just a really shit zone to put in a P2. So, you know, this one is going to get taken out. Not only that, you know, you apply some basic TA. We bounce from this really strong zone. So this zone that we were looking for. When we made this low, I was saying, okay, this is a really strong low. The reason I was saying this is a strong low, and this is something, you know, that's very useful, is that if you see, well, let me rewind so I explain this correctly. because in framing trades, I find it's really important to understand where we come from, right? If you understand to understand where you're going, you need to understand where we came from. And in order to do that, we must understand the context. So we were looking for a low in this area, right? That's just the A. I was looking at between 90 and 91K, in this case, 89.8. I have my reasons for that, which I don't want to get into too much because, I mean, if you want to know, then ask, but I don't want to make things too extensive and complicated. But in any way, this was a good zone to look into. So we tap into that zone. It's like high value node here, POC, high value node here. We tap into this zone, and then we have a bounce, right? Not only do we have a bounce, we also have a very good low. This is why I was saying at the time when we hit it, and let me just hide the indicator right here. At the time when we hit it, I said, yes, this looks like a really nice low. The reason why I said it is not only did we have 1, 2, but kind of that 3 drive setup, but you also have, in terms of candlesticks, a very nice low right there. If you go on the 4 hour, so this is what I'll see. What for good lows and good highs, what you usually see is, and you see it much better on these bars, you have this low right here. So you have this low, then you have a lower low right there, and then you have this higher low right there. So you kind of have this, triangle, not a triangle, but this 3, I don't know what to call it, but it's just like 1, 2, 3. That's kind of it. I mean, if you just go do some back testing, then you see that most like really good here, for example, 1, 2, 3, 1, 2, 3. Not here, there's obviously exceptions, but a lot of like the really big lows have on some time frame have this kind of bottoming formation. Here you see it as well, right? 1, 2, 3. Here as well, 1, 2, 3. Not only that, so this is the 4 hour. Then you look on the daily, you had the same thing, right? Look at that, 1, 2, 3. This candle was obviously still being made by yesterday, but you can already look ahead and think, okay, we have that first tap here, first tap there. Then, basically what this is saying is that, okay, we had this, we put in the low and the next day opens higher and then wicks a little lower, but not towards the low, right? That's something you want to see that shows strength. So we now have 2 pieces of the puzzle, which is A, we tapped a really important zone, right? The zone we were looking for a bottom. So we tapped that zone. 2, we also have very nice bottoming formations on both the 4 hour and the daily time frame. 3, we actually have a bounce following from that, right? So we actually bounce from that. 4, we have the statistics that I just showed that make it very unlikely that we're going to take out this low. So we have P1 at hour 0. So this is what I said, right? If you want to see a trending day, you prefer to see P1 close to the daily open. And this is not something I'm just saying out of experience. I've actually seen this in the data that almost all trending days, so that have like the top 20% trending days, right? So basically all trending days, most of them happen when P1 is close to the daily open. So you have that, right? So strong reaction. Then we have those statistics that, well, we have P2 at hour 10. We have the distance statistics telling us that there is a 13.6% chance that you're going to take out the daily low. Okay, so now we understand where we came from, right? We had the bounce, we had a good low, we have strength, we have all those pieces. So it looks likely that you're going to see higher from there. Now, what I did then yesterday, and again, this is all in the Discord, I showed it live, so rewind it, but I just want to explain this theory, right? So we have this daily bias of ours is now up, right? We must go up more, most likely. This is our bias. And this is where our New York session opens, right? So this is the New York session that we use at Minoma Analytics, which starts at 12 p.m., right? So it's not the actual New York Open, but this is the sessions we work with. So 12 p.m. until 8. What we can do then is do the exact same thing as we did with our weekly intervals, but only on a session basis, right? So what we did is, I mean, I cannot do it now because it's probably being calculated for the current session. So what we did is just select the session time frame, and what this is doing then, and again, I'm sorry for the design stuff. This is the develop mode. I will make it much nicer in the period to come. But what this is doing now is giving us the P1 and the P2 80% confidence intervals for the current session, right? So this is the current session, so this is not for yesterday. But yesterday I did this, and what I saw was, okay, these are our ranges. or this is our range for the session. So basically what this is stating, let me switch back to HoloCat. So these candles I like to use to look for good bottoms and highs. Very nice candles to use for that. I don't know, it's just somehow much easier to see good highs and lows using that. So what we know now is that to pay 40%, and I've now escaped this, oh, I've forwarded. So but yesterday what I posted is, okay, so we know this, and what I said is, okay, we know everything, we need to go up, right? That's highly likely that the daily high is up. I can, I'm not gonna look for it. I just like, there's the post in Discord. But so what I said is, okay, we know it is up. We now also know our session ranges for this, this current session, so the New York session. And the New York session is the most important session of the day. Most displacement, generally speaking, and most volume, and volume equals displacement, seen that in the data as well, occurs during the New York session, right? So most displacement for the day will happen then. So what we know now is, okay, we have the session. What I said is what you can simply do is you can use this to refine your entry. So what I said is you can draw a fib and just, I personally really like the 0.5. I see it gets hit a lot. So what I said is you can just put your entry at the 0.5. And this is, I was saying this right as it happened. Normally what we would do is, because the first logical target is P2, right? If you want to be conservative, taking out the high. We know we at least must take out the high. But right now we have some another piece of information. We know that 80% of daily of us these session P1s will be in this green range right here, right? So the session low or the session high, whichever will come first, will be within this range. But we know that it will most likely be the session low, right? Because our bias is up. We have done all this contextual analysis, and you know, it's a good low, we have good reaction. We have statistics on our side, right? 10% chance of taking this out. So if we're going to see further displacement, most likely it's going to be to the upside. What we can do with that information is say, okay, well, if the low of this session, of this New York session, is, or if the P1 is going to be the low, right? So if the low of New York is going to be put in before the New York high, so something like this, then we know with 80% certainty it's going to be somewhere here. 80% certainty, right? So this is how we use contextual situational analysis, just analyzing where we came from to say, okay, and the statistics for today of where are we most likely to go, and we can use that to say, okay, most likely the New York low will be P1. And then we know with 80% certainty, it's most likely going to be within this zone right here. So what I said is, in this case, you could just layer in, just put an order at the 0.5. Like honestly, you can check it when I posted it. It was right at the bottom. But then what I said, instead of putting the stop loss here, you can put it here. How you want to handle that is up to you, because obviously it's not that it cannot go below this and still go up. As I explained, with 80% certainty, you know P1 will be within here. So that means that, or sorry, not within there, but within here. So that means that there's, if you put your stop loss below this, there's pretty much an 80% chance that it's not going to get hit. You could choose to use a soft stop loss and so on. Or with a soft stop loss or hard stop loss, it's up to you. But this is what I was saying yesterday. And then what I was saying as well is that I think you had like a naked daily point of control somewhere here, or somewhere just lower. I think it was right above these highs, somewhere there. So what I'm saying, okay, and then what we can do is we can look at the session P2 interval high and make sure, like if you're day trading and you say, like, okay, I want to close it before the end of the day, then naturally it makes sense to look for a resistance point somewhere within here, right? Because we know that 80% of price will end up somewhere within this zone. Now, I come back to the point I made earlier on the weeks, is that the other 20% are trending days, right? So in this case, you do have the perfect setup for a trending day, because like I said, you want to see that trend day have P1 close to the daily open, and that pretty much at least allows for the possibility to have a trending day, right? If we would have done something like this, it would be much less likely to see much higher prices than the session P2 interval high. But now we know, okay, 80% of these sessions will end up somewhere in here. Well, in this case, we know it will be higher because of all that we did. So 80% of PA will end up somewhere in here. So in this case, we had a naked daily point of control right there. So what I said was, okay, well, that makes for, that's not that. So, and that is well within the 80% range. So if you want to be, in this case, I would find it quite conservative. Then this makes for a nice target. But it's a really good trade, 3.8. I honestly think you could even get away with 1-1 or art if the win rate is high enough, which can do. But then, that was the logical conclusion. So what we have now done is find an entry using statistics, the entry was just a 0.5, I guess. But we have a direction using statistics up. We now have an invalidation using statistics, which is below here, right? If you go too far below this, like the further you go below this, the less likely it is to have a P1 within that zone. And we have a target because we know it. Well, we're well in that 80% conservative P2 interval high. We're well in that range. And it's a very good point of interest because it's naked point of controls and they're really, really powerful. Now, in the end, price just slammed through it, which obviously happens. It's, still a great trade in my opinion. You could have chosen to keep it open. But the interesting part then again comes here the following. As you also know is that I was looking at the fair value gap but above it, right? I said that's probably the last thing that could hold us back. Now, what's very interesting is that the fair value gap was right above the P2 interval high. So again, 80% of price action ends up in here, right? The session high, 80% certainty is going to be somewhere in here. In this case, we had a trending day. We went a bit higher, but you do see that prices not go that much higher, right? And the reason, or at least one of the reasons, is obviously we had this fair value gap, and I made a post about this while I was looking at this as resistance. We rejected from it, which is not a weird thing because statistically speaking, there was a high chance to reject from it than to crush it like that. I covered that in the post. But also it's at the edge right here, right? We know that we're already in low probability territory because price is going higher than 80% of the sessions would go. But you're still somewhere at those exhausted areas. So knowing this, would you really bet on price going much higher than this? Or if you're in a long, would you prefer to, take profit there for the day because you're like, well, I reached this massive last resistance, so to say, and it's right above that 80%, the P2 interval high. So therefore, it just makes a lot of sense to take profit there. And I know I'm saying that as someone who didn't take profit from here, but the reason is because I'm just building like a swing position, and even if it's doing this, I will just add. I don't care. I'm just aiming for that swing position. But if you're day trading, then obviously this makes for a really good take profit because you're at resistance. This is resistance. Like statistically, we know this is resistance with a 70% certainty. And you're also at the edge of where you can, of where usually sessions go. So, all those things combined can make it for a very logical place to take profit in case you hadn't already, right? My take profit was here. Right. Quickly jump in the chat. Can you show the fair value gap of ETH likelihood of first step? I am going to dive into that. Thank you for reminding me. I completely forgot. Let me first check if there's what's up, Rafael, Kevin. I'd love to know about the 91,800 reasoning. If it doesn't sidetrack you too much, 91,800 reasoning. Why I chose that as low. Yeah, let me get into that. I'm first going to handle the Ethereum question, and then I'll go into that question right there. But anyway, I hope, what's up, Ed? Admiral Ed, good to see you, bro. But what I hope you can take away from this is kind of see, first of all, how these intervals work, why they make sense, and also how to use them, right? To find invalidations, to find direction. For example, I don't want to make it too complicated. The ways you can apply them is obviously only limited to your imagination, I would say. There's multiple ways to apply them. I'm just giving you the thoughts I have on them. I have multiple ways already that I can see in which they would make sense to use them. But I don't want to make things too complicated. So for now, I'm just going to leave it at this. I hope you understand how to use them, how to use them to determine direction, to determine likely pivots, to determine very good trade zones and exhaustion zones, as we did right here, right? So I do think this is a very nice use case of how to use them. So I hope that makes sense. With that said, we're going to dive into ETH. So because that was a nice one where indeed I completely lost track of that in my whole rant about these things. But indeed, what I said was, and we can do this again, that okay, so now you know this is going to hold for the week, right? Very, very likely. And you're kind of starting to create this base right above here. So if you believe ETH's going to continue to go up, and in this case, I would like to check the data on if the same is true on trending weeks, trending days for weeks, or trending weeks, that it needs to be close to P1. Because for days, it really is true that, you know, the closer you are to P1, the higher probability of a trending day. If it's the same for the week, then that might make us a little bit more cautious here, saying like, okay, this is just going to keep going. But again, another thing that could happen is just something like this, tap, and go. But fair enough, we have statistics on our side. So we know that this fair value gap has been created right there. The indicator I like to use is this one, fair value gap from Spaceman. Maps them out really nicely. I personally prefer to look at the big ones. So for example, here we saw, so we also had that amazing tap right there of the fair value gap. Not only that one, I believe, I think that it was also daily here. So you could actually use statistics to determine how likely this fair value gap was to break, right? We have that data. I know Ed was using it. So Ed was looking at this fair value gap, and Ed was warning us all to say, guys, look at ETH. Look at ETH. Ed came into the Bitcoin chat saying, yo, right, how are you guys looking at Bitcoin? It's time to look at alts. And you're right, man. So Ed was actually looking at this fair value gap right here. You can look at the statistics saying like, okay, how likely is that thing to break? So, you know, we go to our beta fair value gap feature right here. Let's see how I'm on time, hour in. I will handle this one, and then I will handle the bottom question of 91K, and then I'll let you know. And then I'll end things. Or end the stream. Let's not sound too dramatic. So for example, if we had the ETH fair value gap, so this one was tapped. So it's 19 days old. Wait, it's not showing the right one. Because it did get tapped there. And it's telling me it did not get tapped, which is false. Interesting. I will look into that. Because this is 11 of 9. Oh, no, this one's older. This one is older. Okay, for some reason. Oh, no, wait, sorry. I'm looking at the American notation. American notation. I know it was this one. All right, well, I'll look into that, why it's not recognizing it. Because I do think Ed was looking at it. But, you know, if that's working properly, you can check the stats. Okay, how likely is this to break? Well, we didn't get that break. We tapped it, went on. That's why fair value gaps are nice. I'm working on a feature where we can see an overview of all fair value gaps like this that are being filled, right? So if we can see those, then that will help us because we can determine how likely it is that they will or will not get filled. Now on the 4-hour, so this was it on the 4-hour, I guess. No, this one, the most recent one that we're looking at. So what I like to do in this case, we have this fair value gap right here, which was made on the 27th of November, which is what we have right here, right? 27th of November between 12 and 4. 12 and 4, that's the candle. So we see now that it's 4 candles old, 4-hour blocks, which is 16 hours old. That's what you see here, 16 hours old. And what we can do is, I see here that the fair value gap size is 1.38%. This is something I like to look at because There's also, fair value gaps like this or this, right? It counts this as a fair value gap because technically it is a fair value gap, but obviously if you look at this with the naked eye, it's not going to be something you would consider a fair value gap. So I'm going to create an auto feature that filters out these things. But for now, what I do is, and I already have it enabled, I just look, okay, how big is that fair value gap? Oh, that's why I'm not seeing it. Now I understand. I'll go back in a bit. I had this filter on. So between 1% and 2%. Basically, what I'm doing is I'm filtering out all fair value gaps, and I want to see just the data or the fair value gap of that there are between 1% and 2% in size. So you can, for example, see how big of a difference that probably is. So, for example, look at these. Let me get you the statistics. If I filter for fair value gap size, you get this. And if I delete this, see, much higher percentage, 72 instead of 65, 55 instead of 42, 33. This one's not that big of a 29. But the higher the percentage of the bigger the fair value gap, the bigger the difference is going to be. So I personally choose to filter based on the size. So I just check, okay, how big is that thing? And that is less than 2% and is greater than or equal to 1%. Right, so then we get the accurate statistics, and then we can take these, and then, well, we can ask ourselves the questions, if it would get hit before, I don't know, the end of tomorrow, right? So then you select 29 November, 8 p.m., then it basically what you're asking is, if this would get hit before the end of, by the end of tomorrow, right, the last candle, what are the chances of reversing it and all that? Oh, shit, sorry. I need to go here. So let me remove the weekly distance intervals. Let me clean this up and just mark out this right here. So there we have that fair value gap that we are looking at. What we can do basically this. So what we're saying is, okay, if this will get hit, and I'm just doing tomorrow because today's Thanksgiving, I don't know if much will happen. And what we can see is that, okay, by the end of tomorrow, 71.4% of these will have had a first tap. So, and right now already 60% of them would have had a first tap. So you're already in unlikely zones. Durable is going, but I'm just going to let it go. So you're already in an unlikely zone, but still, a decent amount look to be getting filled. You can see that more if you look at just chart right here, right? The further this incline, the more fair value gaps are being filled. So, there's a decent chance of a first gap. And then the next question is, okay, but how many are going to get fully filled? And the real question is, how many are going to reverse? So again, the reversal is closing below here. Close below here is reversal. So a 4-hour candle, that's the rule. So if that happens tomorrow, then there's a 35% chance of reversing it as well, which means there's a 65% chance of holding it in that case. But the thing is that the sooner this happens, the more likely it is to hold as support. So for example, if you look at the end of tomorrow, or the end of today, sorry, then those same statistics will be 29%. So just doing this one. So if it happens for the end of today, then basically you have a 70% chance of this thing holding. All right. And the general rule is the bigger, you can see that in the data, but the bigger the fair value gap, the more likely it is to hold. And this one, it's not that big. Like this is not the grandest fair value gap. What was a really good one was definitely the one down here, especially on the 4-hour, the one we tapped here. right? But you could see, like, for example, this one, 31. So, I mean, this, if this would get hit today, it's an interesting zone because also you have pretty much a SR flip level right there, right? If you tap this today and you flip it as support, then it might actually be a nice one to ladder into a swing long potentially if this is the breakout. But I would want to, the sooner you hit it, the better, right? The sooner you hit it, the better. That's what the data shows. But if you have, for example, if I delete this, and then there we go. That's why I couldn't find it. I think it's this one. So here, this one got tapped, and this one was between like 3.8%. So that's really big. So I would just do greater than 3%. You see there's 98 of them. That shows you how big it is. And what basically happened at this point is 168 hours is oh well, I can just check. So it got tapped here. So oh yeah, so see, so this is what you want to see. Oh wait, it got hit after 5 hours. So the first tap was here, and we actually tapped it again later. But after 5 hours, we tapped it, and look at these odds. So at that point, you have a 61% chance of tapping it, right? Which we already did. And there's a 12% chance of filling it fully and a 6% chance of reversing it on that same 4-hour candle. Even if you go a couple of candles ahead, this is like the next day, the end of next day, there's still only 12% chance of a reversal. So if you see this is almost a no-brain long, right? Where you're looking for to reclaim this and possibly entering it higher. At this point, we can check. So this is, I think, what Ed did. 30 bars in, we hit it again, and you can see still there's only 30% chance to reverse it by then, So it still acts as support. The lower this is, the more it acts as support. So still a great time to long, right? So that was a really nice one. Right now, I would be looking at this one, and preferably you would hit it. I mean, today would be ideal. Tomorrow, still support. After that, it's going to hold less and less significance. But this is the level to look for, right? SR flip, lower is reversals. So this could be. I mean, what would be really nice? Oh, and this is actually where you can tie everything together. I'm suddenly thinking, like, what am I doing? But we can actually check. We can go to the 80% interval ranges. We can calculate them for ETH. So we add ETH. That ETH. That was ETH. Add them for the day. Add them. Check. So then we see the P1 interval low 3590, 3729. So I'm just going to ballpark that 359. Yeah, look at that. Perfect. 3590 and 9 or 3729, 3729. All right, so this is your P1 interval range for today on ETH. All right, so somewhere within here, you want to put it in. So then you come to the same thing. This is still within the 80% range. So if you would see something like this, then it would not be a weird place to take a long. But I don't think it's going to happen today because New York is closed, right? But this is pretty much how you use it. So you have that point of interest within the 80% interval range. Tomorrow will be the same thing. If we open here, and then this will be surely within the 80% interval range. If you do this at the start of the day, then that's something you definitely want to look for a potential long. That's how you use it, right? So, but the statistics for this one is what I just shared. So more or less 30% chance if we hit it today, 35% chance to reverse if we hit it tomorrow. But it's not the biggest fair value gap I've seen. I prefer them bigger, and I'm gonna make a really cool feature where it's gonna be really easy to spot them. But this is definitely a level I would be looking at. All right, so that's it for all the explanations in terms of statistics, 80% interval ranges. Hope you guys are still with me, not bored out of your minds. And now we're going to look into why I chose that zone of 9091K real quick after I take a sip of water. And then I'll explain why I chose that 9091K and why I wasn't looking at 84K. All right, isn't this nice, by the way, what we're seeing so far? Where prices in between these fair value gaps, right? And that's because both of them have a higher probability of holding than of not holding. So it's what I said at the start of the stream. You could, there's definitely a case to be made where you just bounce around in here for a while, which is right now what's happening because this is resistance, this is support. So I say no trade zone. Anyway, why did I choose the 90-91K zone? Because even from here, what I said is, okay, basically what I said, okay, there's two options. We're going to get like a shallow, long retracement, or we're going to get a steep retracement. The steeper retracement will put in a low sooner. But I said from here or something, I said, I see a lot of targets for people screaming for 84K. 84K was something I heard a lot. I said, I don't think it has to go that low. I think 90 to 91K is low enough. Now, first things first. We don't know yet that this is going to be the low, right? There's still a very valid case to make that the low needs to be taken out. I've talked about this extensively. I don't think it will get taken out this week personally because of this support zone that we have right now. But, that's just me. This is the kind of thing you want to see with the fair value gap, big fair value gap, and then tap into it soon and continue up. So not something I would trade against. I will also integrate this in the dashboard that it's going to be very easy to see that. If you're, for example, looking to take out the weekly low, that the dashboard will kind of just say like, hey, watch out, there's a big fair value gap in between. That's strong support at the moment. I will build that. I'm working on it. But so I don't want to get ahead of myself and start running victory laps and say, hey, this is low. But yes, what is for sure already is that this was an important zone. This was a bounce zone. We have seen quite a significant bounce from it, and a lot of people weren't expecting that because they were looking for lower. We might still get lower, right? I'm not saying that, but I personally don't think even if we sweep the lows, I don't think it's going to be that much lower than this. So with that out of the way, why did I choose this zone and why wasn't I looking at 88K? This is partly technical analysis, partly sentimental analysis, right? I always take into account what most people are thinking, and I understand this is a subjective art, so I cannot really say a lot about that. But the reason I was looking for a high to be put in here with, and as you might remember, I said I was looking for a high end of November, and I specifically said 24th of November or 23rd of November. So here's what I said. This is where I said, okay, looking for a high, and we made it with 1 day to spare. 1 day and 8 hours I was off. So, we were looking for that high, and then the next question becomes, okay, but where is this going to take us? Now, there's three things that are important here. Context, and I'm going to make a post about this later, but there's context, and that's what I'm going to start with. Then there is simply technical analysis, and then sentimental analysis. So let's start with the context, right? Let's start. The context is very simply that we're in a raging bull market, right? That is the context. It really is as simple as that. People are too zoomed in on these charts. People are too zoomed in on these charts, and they forget about hype. I mean, just look at this. Look at this, right? Look at the monthly. Look at it. Crazy, man. Like this is, if you're still at this point saying like, oh, it's a bull trap, we're not in a bull market, or it's not confirmed yet, it's crazy, man. Like this is a confirmed breakout. More than willing to put that on the table. If you see PA like this, just up, up, up. We haven't taken out any significant lows since here. Well, since the bottom. You see, and the lows just keep getting high. Here, you didn't even make a low, right? This is not even a pivot low, but you can just see the direction is up. Not only is the direction up, it is very aggressively up, right? Very aggressively up. So, of course, at this point, this is why I said we need probably a little bit of retracement at some point. You need to get some form of a cool down. But just because we get a little retracement doesn't negate the fact that the main trend is still up. A very easy way to do that is go on the daily and just take, you know, the EMAs. I mean, look at how far we still are from the EMAs. Even on the 12-hour and the 6-hour, we're just touching the first one. So, and here, even on the 4-hour, you're still not losing the 100 EMA. So you're very bullish, right? That's what I'm trying to say. We're very, very, very bullish. And you know, the side is on with the bulls. We're in a breakout firm. So the context is we're in an impulse stage, right? And this impulse stage can last a while because we had freaking 250 days or something of consolidation. That's huge, right? So people are like, yeah, but we've already been impulsing for what, like 44 days. 44 days is nothing if you compare it to 250 days, right? You have to put it in perspective where we came from. So, for example, if you just take it from like the very low point here, and this is where I always take my time in perspective, you know, from the low to the high of this, because this is pretty much one big impulse, right? That's a 209-day impulse. If you would look at that the same way from here, which is, I think, a completely reasonable thing. I do think this one is going to be shorter, actually. So let's say this one's going to be a bit shorter. You know, it's going to end on Trump's inauguration, which is what I think is going to happen. But still, you know, you're not near the end of that yet. And even if you're near the end, an impulse like this almost never has like an extreme blow off top that just happens like so, you know? Just never happens. This very, very, very rarely happens. Very rarely. You wouldn't see that. But even if an impulse, like a really sharp retracement must happen, then it would most likely be more at the end of this, right? That's where you're looking at. Not right now, and still like well in the zone of just a sharp impulse stage. There's no sign yet that we're ending this. So that's a very long way of saying we're bullish as fuck, right? Really bullish. So you're really bullish here. And that's the first thing, right? And then you're like, okay, so I'm very bullish. So what does that mean, right? Well, that means that dips are for buying, right? Dips are for buying. If you're very bullish and you're going to get 10% retraces, then what's going to happen, right? What's going to happen? We have people freaking out at 100K because I went out for drinks here on Friday and all my non-crypto friends were talking about buying Bitcoin. That's a local top signal, right? So these people are buying Bitcoin at 99.7K. They're literally buying it because like, oh yeah, it's going to go over 100K. I tried to tell one guy like, man, this is not how it works. I would wait a little bit. But he got angry with me and he was like, no, what are you talking about going higher? And I was like, all right, man, suited yourself. That's how they think. So we reject. These people are freaking out, right? And it's like people are saying, yeah, but we need to shake out the leverage longs. Listen, these people that are at 100 buying at 99.7K, they're freaking out here. They are freaking out here. They don't need to go here to freak out. Here, people are panic selling. You see that in on-chain analysis as well, right? This is en masse panic selling for people, right? So you have already people panic selling at these levels. You have an extremely bullish environment still. And if we would see like a reversal of that bullish environment, surely you would see some kind of distribution, which we do not have yet. And you have to think by yourself, okay, so market makers, you know, or smart money are going to be buying dips, right? Because in a bull market, in a bull impulse, smart people know that the retraces down are aggressive, and it's to shake out weak hands, and those are buying opportunities, right? So that's a big piece of the puzzle. And then the next question obviously becomes, okay, but why then the 91K and why not lower? Why does, because of course, like there's a lot of liquidity here, and it's basically the same reason why I said here, like everyone was here saying short, short, short. I would say no, long, 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 right? If you remember, a lot of people were shorting here. We went long here, right? Right here at the top. Like we literally went long at the top. There. This is where a lot of people in the Discord went long. And it was a great long. And because it made a lot of sense, right? Because a lot of people are expecting those lows to be, it's too perfect of a target. I'm not saying it cannot happen. But in this case, it was the same reasoning. Price was way too bullish, way too bullish. Now there was more, like here, there's, after this run up, that's why I got bearish as well. There's more signs for a reversal. But the thing is that, well, first of all, let me actually make that final point clear, that 10% shakeouts is more than enough in such bull run, right? So that's what I'm looking for. I'm kind of like, okay, because you're in this impulse stage still. There's no signs yet that this very big impulse is going to change. Look at this, for example. Here, basically what you have here in this whole impulse is this structure. Low, high, 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 low, high, 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 low, high, high, right? This is structure. So if you look at the ones before that, what do you see? Here, 9.7%. Here, 9.3%. Oh, wait, I missed this one. 11.5%, 9.3%. So say you're at 10%, take it somewhere in the middle. Then you're, this is also why I think you need to go a little lower. Let's say, it's somewhere, it's close to there, right? Like 9.9%. So this is pretty close towards that same kind of retracement you're seeing. And I do believe you're kind of in a similar retracement stage, because we're still impulsing up. And again, we're coming out of a 255-day consolidation. The market can stay retarded for much longer than you think it can. So, you can see here that 10% shakeouts is more than enough. Also, if you look at here, which was kind of similar, we had this, very long consolidation. And if you just look at, well, first of all, what is the first really big retracement? So this is also this was the first big retracement, which was also 9.7%. How long did that take from the low? People always overestimate how deep the heads go. They're like, 20% shakeouts are normal, 30% shakeouts are normal. No, they're not that normal anymore, and they're getting less. And if they are, there are very specific times when they happen, and that is usually at the end of very big impulses. So, this is 10% shakeouts, more or less, or is this one maybe the first one? Let me check. Yeah, this one's the first one, but we've already had one, right? So this is the second one. We've already had two there on the way up. So let's say it's this one. So, you're still, actually beautifully, look at that, right? You're right in that range. And I do think that's, we're in a similar situation. So do you see that this shakeout happened at exactly the same time, relatively speaking, to this shakeout? Let me just copy that. There you go, right? Or to the top is right here, 229 bars, 229 and 227 bars, almost the same thing. Let's say from the top, 218. Really close, right? So you're more or less in that same time period. So price is dumping there. When you see the first real proper shakeout here, it's only after 296 days. And this is January 1st. I could see that. I really think we're going to see some form of local intercycle top around the inauguration of Trump. But so anyway, you have that. That you can just see, okay, 10% shakeout is more than enough if you just look at the context we're in right now in terms of the cycle and the impulse, right? So we're in that impulse stage. So then you have all that as context where you say, okay, well, 10% is likely enough. Then what you do is you do some basic TA. So what I just did is I drew this. Well, it was here at the time. And then you can see that, okay, the important areas obviously here, the point of control. Point of control, like high time frame point of controls, like volume is so important, man. So this is obviously a very important area. And then the next high value node is right over there, right? High value node, high value node. So for me, if I look down, this is the first important area that you're going to see. The high value node area right there, right? One high value node to the other high value node. That's basically, this is what I drew here as support, right? Just clear as day. That is the first important area. Now, that also lines up with the fact that it's more or less, 9% down from the high. So that area is really nice. And I've already established that I think a 10% drawdown is more than enough in this stage of the market, right? At some point, we're going to see a bigger drawdown, but it will probably take a little bit longer. Like, for example, here, if you look at this was at the end of the impulse, which was 17% at first, right? So I'm talking about this, but this was at the end of like the really big impulse. We're not at the same stage right now. We're just not at the same stage. So you cannot, 17% is already a lot, right? Because this is a really big shakeout at a really important area. I mean, you had one here as well, also a little bit later in the cycle, but say 20% is a little bit the max of what you can say. But it takes a while for that to happen. It might still happen, but I personally don't think at this stage we will. I think more range is more likely, but let's see. But for sure, this is the first area you must be looking at, right? Because it's in that 10% area. It is the first really high volume area. So this is something you want to be looking at. Plus, so then I have the context sketched out. Then I have my technical analysis sketch. So, well, the context, I know in which part of the cycle we are, more or less, right? Then I have my TA. I know this is a very important high volume zone. I know that 10% shakeouts are probably more or less the way to look at it, or the best range of where you are right now. Because if you take all this, then that is 15% shakeout. I just don't think it's time for that yet, based on all that I just said. And then, I post about a retracement, and then all the targets I see is 84K, 84K, 85K, 86K. I mean, 88K I can definitely still see here. But then if I see 84K, so everyone's looking at this. So, after doing all my analysis that I just did, and I'm like, I've already identified this zone as like, okay, I think this is the zone to look for, right? Because of all that I said, we're bullish as fuck, like dips are for buying. We're in an impulse stage of the cycle. And then after that, I go in and I see everyone looking at 84K. I'm like, okay, if that is the main narrative that people are looking for, then usually that doesn't get hit. That's just how it works. And I'm not saying, it's a combination of things. You cannot just go on Twitter and say, okay, well, everyone's looking at 84K, so probably you won't do 84K. But I've already established this is a high probability zone. Then I also see, that everyone is waiting for this. And I'm like, okay, that's probably not going to happen then, because all these people are obviously, there's also a lot of sideliners there hoping for that to get to 84K because they're sidelined, they want to get in, and they're hoping to get that 84K entry because then like, oh, finally I can get in at a really nice discount and ride this. And then usually the truth lies more that price will not get that low. It's always like in situations like these that price will, when you have a retracement, that price bounces earlier than most people expect or want it to, because they don't have a chance to get in. At some point, that's going to change, right? At some point, you're going to get to a point where the price is going to bounce later than you want it to. That was the case here. This is why I, posted here saying like, okay, we're done. Long only mode. I said here that long only mode is over. Right there is where I said long only mode is over. We're going to consolidate. 17th of April, made a big post. Because the context there was different, right? There you could expect it, because here everyone was conditioned to say, "Oh, we're just going to go up forever." Right? We had this just massive 50-day run up, 55 days, I think. Where are we now? And now we had 18 days, and this was basically 50 days. So here you had this massive conditioning of everyone to say, "Okay, long only, long only." Here we didn't reach that stage yet. I mean, if you take it from here, this is the lowest point. We're getting closer though. 43 days. But the difference I'm seeing right now with here is that here everyone is max degen leverage long, and here a lot of people got left behind, right? A lot of people got left behind. They're waiting for an entry, and they're not getting it. And that's, a lot of this 84K is wishful thinking, hoping that price will get away. So usually you don't see that low in a stage like that. It's a massive bull market. We're very bullish. Dips are for buying. So, I would personally be more conservative in my retracement targets in that estimate. I can still see something like this happening. Let's see if it happens. But this is the reason why I was looking at this level instead of all the way down here. It's too obvious, right? At the very least, if you're going to go here, you're going to go there in a way that no one expects, right? Like here, go here, Like, hey, 100K is coming. Oh, no, it's not coming. Oh, oh yeah, we're going up again. And then bam, something like that. That would be like, if you go there, then this is probably a good way of doing it. All right, but that was a very long answer to saying why I was looking at that. If you want to know the very simple reason, this is the first high volume area in a very strong uptrend. Very, very strong uptrend. And very strong uptrends do not V-shape reverse into a bear trend. Just rarely happens. So if you're in a very strong uptrend like we are now, the first 10% dip into a high volume area is a buy. That's how smart money will think. So that's how we will think. All right, so that's a long form explanation. I am 1.5 hours in. That's my sweet spot. So I'm going to round it up here. Let me just quickly see what Bitcoin is doing. Probably nothing. Yep, nothing. Oh wait, I'm looking at the old chart. Yeah, so just bouncing around there. It's also on top of the very area high, actually. Oh well. You know my thoughts on Bitcoin. You know my thoughts on a lot of other things. I hope you learned something about the 80% intervals. And with all this said, I want to wish you a very nice Thanksgiving weekend. In case you're celebrating, we'll be back with streams next week. I'm going to do a stream again with Trader Tim. Bundle our forces again to look for some nice setups. It'll be fun now with the new 80% intervals. It will give us a lot more options to look for a good how do you say it? Good setups ahead of time, also on the weekly time frame. So once again, everyone, thank you for listening in. I'll catch you in the Discord. Any question, let me know in the chats. I'll see you in the next stream. All right, guys, have a good day.